and ordinary people still participate in the stock market boom. The stock market surges to alleviate debt. If you don't participate, it will keep rising. Do you understand? If you lend your friend 100,000 yuan, and as a result, he loses money in business. Not only is the money gone, but there is also a lot of foreign debt. Are you also worried about your money? At this very moment, he tells you not to worry because he had previously bought a stock. In the past few days, it has increased several times, and after paying off all the foreign debts, there will still be quite a lot left. Don't you feel much more at ease? Isn't the bank the same? You deposit money into the bank, and if the bank runs out of money, the debts that have been lent out are not coming back. Are you also worried about your savings? Real estate companies' debts, such as Evergrande, and the hidden debts borrowed by local urban investment companies. Where does their money come from? It all comes from the bank. If these debts cannot be repaid, everyone will be worried. At this time, the bank tells you, don't worry, paying off the debt is not a problem. This year to the 6 major state-owned banks. Agricultural, industrial and commercial, construction, transportation and oil storage have supplemented 500 billion yuan in capital funds. Some people say it's not enough. In addition to the 6 major banks, there are also 12 joint stock banks across the country. Together with 124 commercial banks, if there is not enough money, there are also bank stocks. Stocks are also money that can be cashed out at any time. If the bank's stock price doubles, is the bank's debt still an issue? For example, if a bank has a debt of 10 billion, but its market value is only 8 billion, which is not enough to pay off all the debts, this is called insolvency. Now the bank's stock price has doubled, and its market value has increased from 8 billion to 16 billion. If there's an external debt of 100 billion, then it's not a big deal, and everyone won't be worried. Debt can be repaid with shares, which is called debt-to-equity swap. This is the most basic principle of stock market debt conversion. Some people will ask, you say it's easy. The stock price doubles with money. Where does this money come from? It comes from you. In July, residents' deposits decreased by 1.1 trillion yuan net, while non-bank deposits increased by 2.14 trillion yuan year-on-year. What is non-bank deposit? It refers to the money in stock, fund, and wealth management accounts. Resident deposits have decreased, and stock funds have increased. Have deposits really started to move to the stock market? But the number of new stock market accounts hasn't increased much. Where did this over 2 trillion come from? In the first half of this year, the number of two-way financing investors, which refers to margin trading, increased by 252,100 people. It surged by 85.37% year-on-year, and the financing amount is exactly over 2 trillion. What is margin trading? Margin trading refers to borrowing money. For example, if you originally have 1 million in your stock account, the securities company lends you an additional 5 million, and you will have 6 million to buy stocks. Only when the stock price rises can you make money. This is called financing, also known as going long. Short selling is borrowing stocks. You first borrow the stocks from the brokerage firm, then sell them to cash out. When the stock price drops, buy them back and return them, earn the difference. For example, you borrow 100 shares of ICBC stock from the broker. Stock price is 10 yuan, borrow it and sell it immediately, and you get 1,000 yuan in hand. When the stock price drops to $8, buy back these 100 shares and return them to the brokerage firm. I bought it for only 800 and sold it for 1,000, so you made a profit of 200 yuan. Only by stock prices falling can one make money, which is called short selling, also known as shorting. This year, short selling through securities lending has been banned, so only leveraged long positions are allowed, and leveraged financing has surged by more than 2 trillion. It is explained that the money entering the stock market now is not a transfer of deposits, but rather experienced investors and institutions are using financing to increase leverage. Having entered the stock market only when bank stocks lifted the market index. These funds have 60% concentrated in semiconductors, chips, and other technology stocks. These stocks have surged, leading to their adaptability rates being too high, and they are severely overvalued. What is the payback period? The payback period, also known as PE, refers to how long it takes for the money you invest to be recouped. For example, if you buy a stock, the adaptability rate of this listed company is 30. That is to say, if you never sell stocks and rely solely on the company's annual profits, it takes 30 years to break even. The higher the adaptation rate, the longer it takes for the company to break even. The average adaptability rate of a share semiconductor stocks has reached 105. That is to say, holding these stocks without selling would require 105 years to break even. And the global standard is only 30-40 leveraged financing funds will not consider the company's adaptability issues. They only consider short-term speculation, which is why the recent turnover rate of A-shares has reached as high as 3.5%. Far higher than last year's 1.8%. What is the turnover rate? It is the frequency of buying and selling stocks. High turnover rate indicates that people are frequently buying and selling. The buying and selling of institutions are generally conducted through quantitative trading. Quantitative trading involves using computer programs to buy and sell stocks, sifting through vast historical data to identify high-probability events to formulate daily buying and selling strategies. Last week, 40% of the transactions came from quantitative and individual high-frequency trading, perhaps sensing the scent of capital entering the market. In the previous trading sessions, bank stocks fell against the trend. 4 major banks fell by an average of 2%, and CITIC 7 banks fell by 3%. Inside the banks are large funds from companies like China International Capital Corporation and insurance companies. This indicates that they will also choose the right moment to evacuate. Tina Finance reported that the major fund has reduced its holdings in 8 chip stocks within the year. Investment Recovery Accelerates what is a large fund. It is the National Integrated Circuit Investment Industry Fund, a solid national team. Accelerating investment recovery means selling stocks to recover the cost. In the early stages of debt-to-equity swaps, substantial capital is needed to prop up the market. Ultimately, it still needs to be handed over to market entities. Who are the market entities? They are retail investors. Retail investors are the absolute market main body, accounting for 99%. Where does the large capital in Chu City come from? In the first 7 months of this year, social financing increased by 5.12 trillion yuan compared to the same period last year. What is social financing? It refers to the total amount of money borrowed by the entire society from the financial system. This year, an additional 5.12 trillion was borrowed. 95% of this is national debt and local debt. Individuals and private enterprises basically did not borrow money. What did you borrow money for? The money from local debt is used for infrastructure construction and repaying old debts with new borrowings. The national debt has a limit of 800 billion. It is specifically designed for securities, funds, insurance companies, and swap facilities. Investing in stocks. There's also a part related to Trump's trade war. Large funds lent to the central bank. We will discuss this in the next episode. As long as the market entities have not fully entered, the index will keep rising significantly. Monitor the number of accounts opened by securities firms and the popularity of bull market search keywords on major platforms. Check if the activity level of retail investors is high. It is an important criterion for assessing risk. Those who have already participated should be aware of the risks. There is no need to participate if you haven't been involved.